What's up, you guys? Welcome back to a brand new video. At last, you finally decided to start investing your money. Well, I got good news and I got bad news for you. The bad news is yesterday would have been the best time to get in. But the good news is the next best time to get into the market is right now. And tell you what, I will break down the ins and outs of the stock market, all of it, how it works. I'll even show you how I go about picking my stocks to get great returns on my investments. Welcome to Big Brain Finance. My name is Karamoko and I make personal finance with the goal of helping you, yes you, I know you got bad money habits, so you better stay tuned. I'll help you manage how to make your money and make more of it. So if you're all about that, and let's be honest here, nobody really enjoys being broke. So do yourself a favor, join the Big Brain University and smash that subscribe button to not miss any more videos. So what are these things they call stocks anyway? Basically, a stock is a share of a company. It doesn't get any simpler than that. For example, when you buy a Sony stock, okay, the company that makes the PS5, even though it's a fraction of the company, granted you didn't buy a couple million shares, of course, you are fully entitled to call yourself a co-owner of the company now. Yep, you are a business owner technically. Now, unfortunately, that doesn't mean you can sit with Mr. Yoshida. For those of you who don't know, that's the CEO of Sony. Buying a stock in the Sony company doesn't entitle you to, get the PS5 before anyone or anything like that. When you purchase a stock or a share of a company, the company then uses those funds to grow and make more money. And when that happens, the company becomes more valuable. Since you now own a piece, that piece also will appreciate in value. So to put it in numbers, if a company is worth $100 and you buy 10% of it, which equates to roughly $10. Well, not roughly, it's exactly $10. I don't know what's wrong with my math today. Their new valuation would be $130. And since you now own 10% of it, the shares you bought will also appreciate by 30%, bringing their value to a whopping $13. Just enough for maybe a Big Mac combo at McDonald's. And from there, you can decide to sell it and make a profit or keep it until it grows even more. Another big reason why investing is so lucrative is because certain companies will pay you a portion of their profits on top of the appreciation of the shares you buy every single quarter. These are called dividend stocks. For every share you own, the company will pay a certain percentage of their revenue, which is a great way to earn passive income. So on top of being able to brag to your friends about owning different companies, you can also say that you make money in your sleep. And the best part of it is you don't have to do any work. Your money does it all for you. And that, my friends, is a big brain move, if I do say so myself. Simply knowing what stocks are and how they work isn't even half of the battle. The hardest part is choosing the right company to invest in and being emotionally resilient. Yes, I said emotionally, okay? You see, stocks are very similar to relationships. Now, don't click out of the video. Listen, bear with me here. You want an attractive stock, the best your money can buy, obviously. A stock that will get you great returns in the future. You want to hold it for as long as possible. Through tough times, when it dips, and amazing times when it goes to the moon. Because you see, in any great relationship, no matter what bumps there are in the road, you must hold on. Just like stocks, you gotta hold on. You want to buy shares of a company you understand, a company you truly believe will prosper in the future. By thinking about it this way, you are already ahead of the curve. Most small brain investors out there just buy and sell stocks just based on emotions or because it went up yesterday, then it has to go up tomorrow. And it just does not work that way. You don't want to pour your hard-earned money in something that just looks attractive, but then regret it the next day when the stock dips. Now that we've got that out of the way, let's get into a few important things you should look at when planning to invest. Let's call this the dating phase, if you will. I'm gonna keep rolling with this analogy here because it's actually kind of funny. This is when you get to know what the company is about, how they make money, how much of it they're making, and how they stand out from their competition. This is also called doing your due diligence on an investment. Sometimes it's called DD, due diligence, but basically you'll be able to make a decision that aligns with your overall investment strategy by doing this. So step one, you want to understand what the company is about and exactly what they do. And the best place to find such information is most often on their own website. Just go on there, go to Google, company XYZ, go on their webpage, click about. Now, most investors do not do this nowadays, especially millennials. You want to get ahead of the curve and you want to know what you're investing in. I mean, it sounds obvious, but most of the times people just look at the stock trajectory. It's been going up for the last few months, so it's gotta keep going up, right? No, it doesn't work that way. Although in 2020, stocks did only go up. Click through their about page, see what services or products they offer, and maybe even read people's reviews and experiences with what they offer. Okay, now step 2, get familiar with the competitors of the company you're trying to invest in. You want to make sure they have, as what Warren Buffett himself says, a durable competitive advantage, which in basic terms means you want to figure out if your company is in a highly competitive market, and if they are, what are they doing to set themselves apart from the competition, if even, because sometimes they all just do the same thing. A lot of chip manufacturing companies, for example, are in a highly competitive industry, and they constantly have to spend a lot of profits on research and development, which is also referred to as R&D. So they have to keep pushing brand new products all the time to stay on top of it. But if you take a company like Coca-Cola, for example, they have been selling you the same Coke for hundreds of years. I'm actually curious when Coca-Cola was founded, but they have never changed their recipe, and they keep recycling their little aluminum can. So think about that before you choose a company. Step 3, read the company's financial reports and study their assets, liabilities, profit margins, expenses, and growth over time. You don't want to invest in a company that, for instance, is in a highly competitive industry, that isn't doing anything to stand out, and is in a lot of debt. Now that sounds like a recipe for bankruptcy there. A lot of these documents can be found on the company's website itself or on finance.yahoo.com. There's also plenty of others there, just a quick Google search away, okay? You should run through the competitors' financials also to get an idea of where the company stands and whether investing in the competition might be a better move. Now, reading through a company's financial statements can be daunting at first because it contains a lot of jargon and numbers, and going into detail on the matter would probably be best in a video of its own. So until I make that video, I recommend reading Warren Buffett's book called Warren Buffett and the Interpretation of Financial Statements. It was a pretty short read, and it will help you make sense of the company's financial statements if you don't already understand. These 3 steps are the meat and bones of doing your due diligence. As long as these 3 things check out for you, you can bet you're investing in a solid company. Analyzing a stock can get much more complex than just doing these 3 things, and I do strongly recommend seeking professional advice before throwing your life savings into the stock market. I make these videos for entertainment purposes, so invest at your own risk. There is no shortage of people who invest based on the fear of missing out, or FOMO as we call it. So if you're trying to make a quick buck, this strategy may not be the best for you. However, if you're looking to grow your money over a long period of time, this is a very basic look into the method you should be utilizing. If all this was confusing to you, but you're still determined to put your money into the market, a great option for you would be to invest in an ETF, which are exchange traded funds. Think of an ETF as a basket of carefully picked stocks. Essentially, buying a share of it gives you a little piece of each of the stocks it contains. The most popular one has got to be the Vanguard S&P 500 with ticker symbol VOO. A lot of investors swear by it. It has yielded on average a return of 7% adjusted for inflation. It's a great way to invest your money, and you do not have to worry about individually picking the right stock. Each of those 500 are considered a top company in their industries in the US. So if you're having a hard time picking individual stocks, an ETF might be the best go for you. And the Vanguard S&P 500 has got to be the safest place to put your money and watch it grow over time. So congratulations, because you made it this far, you're definitely determined to start building your wealth and take your finances to the next level. And I got great news for you. Webull is having an insane promotion where you get not 1, not 2, not 3, but 4 free stocks after you sign up and deposit $100 after opening your account. And obviously you can take your money back to your bank account if you don't like the app, and you get to keep the free stock and buy McDonald's with it. You can buy chicken nuggets. So who doesn't like free money? I'll leave the link in the description, so go ahead and get that free money. If you enjoyed the video, you already know what to do. Click the like button and subscribe to the channel. Better yet, smash the like button, destroy it. Just literally go down below the video, find the like button, and you want to aim for the middle, okay? You don't want to aim on the side because you won't get a good shot at it. You want to aim for the middle of the like button and exactly just. Thank you so much for watching the whole video. For more Big Brain content, make sure to follow me on Instagram at Big Brain Finances. Link down below in the description. Have a blessed day. See you in the next video.